Today, we're diving into a powerful tax strategy that honestly most people have never even heard of. Not even a lot of accountants know about it. It sits right at the intersection of inheritance, real estate, and a little-known rule that could literally be worth tens of thousands of dollars to you. So let's get right to it. If you've recently inherited a property that has a reverse mortgage on it, I want you to listen very closely. You could be sitting on a massive tax deduction. But here's the catch, right? Almost nobody knows how to actually claim it, and you can be sure the IRS is not going to send you a letter telling you how. It all starts with what I call the inheritance trap. It's a really common problem for heirs. A loved one passes away, you think their affairs are pretty much in order, but then this huge bill shows up out of nowhere. The reverse mortgage is due. Now, the two most important words on this slide are accrued interest. See, with a reverse mortgage, your parents or grandparents probably didn't make any payments for years, maybe even decades. And all that while, the interest just kept piling up and up and up, compounding silently in the background. And that leads to a truly staggering payoff amount when the loan finally gets called. And we are not talking about a small amount of money here. It is incredibly common for the accrued interest alone to be well over $100,000. In this case, let's say $150,000. And just like that entire lump sum becomes a debt that has to be paid, which, let's be honest, often means selling the family home to cover it. Okay, but here's the crucial part. This is where it gets interesting. That massive interest payment, it is a tax deduction. But there's a problem that trips up, I'd say, 99% of people. And that problem is also where this hidden opportunity is hiding. You see, the entity that technically pays the interest is the estate itself, usually when the home gets sold. So the estate gets this huge $150,000 deduction. But so what? What good is a giant deduction if you have no income to deduct it from? In its final year, an estate often has little to no income at all. And poof, just like that, the deduction is basically wasted. It vanishes into thin air. It's useless. Unless you happen to know about a very special mechanism buried deep in the tax code, a kind of teleportation device that can move that deduction from the estate, where it's worthless, over to you, the beneficiary, where it becomes incredibly valuable. Now, the official name for this is excess deductions on termination. It sounds super technical, I know, but all it really means is that thanks to some very specific IRS regulations, in an estate's final year, any leftover deductions don't just disappear. They can be passed directly to the heirs. And let me be clear, this is not some sketchy loophole we found on the internet. It is explicitly allowed by the tax code. It's backed up by federal regulations. The whole process really just boils down to using one specific box on one specific tax form. And this right here, this is the teleportation device I was talking about. When the executor files the estate's final tax return, that's Form 1041, they report this massive interest deduction right here in Box 11 of your Schedule K-1 using code B. That specific code is a signal to the IRS. It says, hey, this non-miscellaneous itemized deduction is moving from the estate to the beneficiary. So how you actually handle paying off the loan, that determines everything. After the homeowner passes away, it really comes down to three main scenarios. So the question is, which path are you going to take? Okay, let's break this down. In scenario A, the estate sells the home. The estate pays the interest, and that deduction flows right through to you, the beneficiary, using that K-1 we just talked about. Simple. Now, in scenario B, maybe you decide you want to keep the house, so you pay off the loan yourself. Well, Treasury Regulation 1.691B-1 allows you to claim that deduction directly on your own Schedule A. But then there's scenario C, foreclosure. In that case, nobody actually pays the interest, so the deduction is gone forever. But hang on, there is one more critical complication. The Tax Cuts and Jobs Act, you might have heard of it as the TCJA, it changed the rules. So now you can't just assume that 100% of that interest is deductible. You have to do something that's basically a forensic tracing test on the original loan. So here's the deal. The law now says you can only deduct interest on a mortgage if the money was used to buy, build, or substantially improve your home. Any interest from money that was used for other things, what the tax code calls home equity debt, is no longer deductible. This is the key distinction you have to get your head around. If the reverse mortgage was taken out to pay off the original mortgage used to buy the house, that's acquisition debt, and the interest on that part is deductible. But if the money was pulled out for, living expenses, paying off credit cards, buying a boat, that's home equity debt, and the interest on that portion is lost.
So what does this mean for you, practically speaking? It means you have to put on your detective hat. You literally have to dig up the original closing documents for that reverse mortgage and figure out dollar for dollar where all that money went. This is the tracing test.
So for example, a lot of reverse mortgages were used to pay off an existing traditional mortgage. Let's say your research shows that 60% of the loan proceeds did exactly that. Well, that means 60% of that huge accrued interest bill we've been talking about is potentially your tax write-off. You just have to be able to prove it. Okay, we've covered the problem, the secret solution, and the big complication. Now, let's bring it all home. How do you actually claim this incredibly powerful deduction? It's really a four-step process. First, trace the debt. Become that forensic accountant and find your deductible percentage. Second, the loan has to actually be paid off. This isn't theoretical. Third, the estate's executor has to file the Form 1041 and that K-1 correctly, using Box 11, Code B. That's non-negotiable. And fourth, you, the beneficiary, take that K-1 and you report that number on your personal schedule. And I want you to remember this. The bank or the mortgage servicer, they're not going to help you with this. Your tax software might not even catch it. This is one of those areas of the tax code where having the right knowledge empowers you to take control. You have to be proactive. You have to be the architect of your own rescue here. And really, that brings us to the final thought. This one specific rule, buried in thousands of pages of regulations, can save a family tens of thousands of dollars in taxes. It really makes you wonder, in a tax code that's so unbelievably complex, what other powerful opportunities are just sitting there, waiting to be discovered by those who are willing to look?